Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Succession and Liquidity, Key Considerations and Options for Founders and Next Gens. It's a conversation with Jeremy Holly, Executive Vice President of Strategic Business Development, and Jared Fingerat, Senior Vice President of LPL Financial. I'm Mindy Diamond, and this is the Diamond Podcast for Financial Advisors. This podcast is designed for advisors like you who are interested in learning more about the evolving wealth management industry through candid dialogue with breakaway advisors, those from the C-suite, and industry thought leaders. It's available on our website, diamond-consultants.com, as well as Apple Podcasts and other major podcast platforms. So be sure to subscribe and share it with your colleagues. At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade. And each year, 25% of transitioning advisors who manage $1 billion or more are our clients. Curious about where, why, and how advisors like you are moving? Download the latest Advisor Transition Report to learn more, including intel on recruiting deals and our insight and analysis on the latest trends in the wealth management space. You'll find it at diamond-consultants.com/transition report. Or if you'd like to talk, feel free to give us a call at 908-879-1002. There's one area in wealth management that seems to have trouble keeping lockstep with the growth and evolution of the industry, and that's succession planning. Research studies indicate that less than 30% of advisors have a succession plan in place. And many more who run thriving businesses have no strategy at the ready should a worst-case scenario leave them unable to attend to their clients' needs or even continue their livelihood. In a recent episode with Jeff Brown from Stratos Private Wealth, it wasn't until a coaching session got him thinking about the future that planning for succession became a priority. And likewise, there are still many other advisors who are looking at the equity they've accumulated in their firms and wondering how they can access it, whether it be to monetize their life's work or reinvest in the growth of the firm. While there's a lot for advisors to consider, the good news is that there are firms that realize that there are great partnership opportunities available with these thriving practices. In this episode, LPL Financial's Jeremy Holly, Executive Vice President of Strategic Business Development, and Jared Fingerat, Senior Vice President, join Lewis Diamond to talk about this important topic. Jeremy and Jared represent LPL's Liquidity and Succession Division, which provides end-to-end solutions for advisors looking to increase business value and monetize the legacy they've built. So they're here to share perspectives for both business founders and next gens on what they need to consider as they grow their business and explore both the long-term and the short-term. They talk about sunset deals offered by the wirehouses and how they might compare to an option from a firm like LPL. And they dive into valuations, sharing what advisors need to know and what steps they need to take to maximize the value of their business. It's a conversation that's relevant to those in the wirehouses, independent firms, and everywhere in between. There's a lot to discuss, so let's get to it.
Jared and Jeremy, thank you very much for joining us today.
Thanks for having us.
Yeah, happy to be here.
Let's do Jared and then Jeremy. If you can each just walk us through your backgrounds that led you to where you are today.
Sure. Well, I actually started my career outside of the industry with Deloitte in their consulting group. And after a few years being in the consulting world, I wanted to do something more entrepreneurial. I wasn't sure exactly what that was going to be, but I stumbled into a firm called Focus Financial Partners. And Lewis, I actually remember talking to you about this because it was the first article that came up when I searched focus was related to Diamond Consultants. And that was really my intro into the wealth management world, specifically into the independent wealth management world. I was on Focus's M&A team and I was with the firm through its initial public offering, and then had a really great opportunity to join some former colleagues at Hightower Advisors that were taking that firm from its initial evolution into its next phase as an acquirer, and was really part of the build out of an M&A team and process at Hightower Advisors. Was there for a few years and then got a call from LPL Financial about coming over and building out a business that could compete with a lot of the firms that were acquiring independent advisors in the marketplace, but do it in a way that was different for many of those firms. And so I've been here at LPL, simply put, leading our acquisitions of advisors for the past 2.5 years, and have been lucky and fortunate to have been joined by Jeremy, who came back this past summer. And I'll kick it to Jeremy to give his background.
Thanks, Jared. Jeremy Holly. My background, I like to say I'm a recovering investment banker. That was my first job out of school. Did that for 3 years, and then was lucky enough to find LPL Financial back in the early days, back in 2002. And so, as Jared said, I'm a boomerang here at LPL. I spent 19 years working at LPL in the finance organization, the national sales organization, back into the finance organization, and doing all things related to M&A and succession along that time. Spent 2 years at a private equity-backed RIA in Newport Beach, and then happily came back to LPL last June. And so now head LPL Capital Partners, get the privilege of working with Jared and other great leaders here at LPL, and happy to be back.
Very good. Love the backgrounds. That seems like the right building blocks for the type of work that you're doing today. Jared, I'm curious from your perspective. Most people have heard of Focus and Hightower, and they're by far two of the most prolific and successful acquirers in the industry. So what were some of your takeaways regarding the most compelling parts of those models? And maybe some of those learnings helped guide some of what you're doing at LPL. But in your view, even outside of LPL, what do you think resonated about those business models in the marketplace?
Sure. So I think Focus stuck to their story from the early stages as being a firm that wanted to back entrepreneurs and recognizing that this independent wealth management space had been built by entrepreneurs. And so I think for Focus, the takeaway was always try to respect the identity and the brand and the way that these advisors are servicing their clients, and don't get in the way of that. Because if you're disrupting the way that they're servicing their end clients, that can lead to some pretty negative outcomes. And so Focus really lived by that story, as we all know, for many years, about backing entrepreneurs, not turning entrepreneurs into employees. And it really resonated with our industry. I carried that over to Hightower with a little bit of a different spin. And I think the takeaway, the big thing at Hightower was building an operating platform that could support entrepreneurs, not disrupt their identities, not disrupt their brands, but add some heft in the back and middle office to make these firms a little bit more successful. But Lewis, I'll close out with an answer to a question that you didn't ask me, which was, what were these firms both missing, in my opinion? And what was the thing that actually attracted me over to LPL? I think it was solving for the next generation of independent advisors. And I think that's still a gap in this aggregator, private equity-backed acquirer space, is thinking 2 chapters down the line about what happens when the founders of the firms that sold move on, and you have a lot of talented next generation advisors that are within these firms that don't have the same opportunity, don't have the same path that the sellers of the Gen 1 did. That's what we've tried to address here at LPL, is what happens next. There's a moment in this industry that's clearly been going on for some time, and I think it'll continue in terms of M&A activity and folks getting a really valuable offer for their business. But what happens when the dust settles and you have these next generation advisors who want to know what's in it for them? And that's what we're looking to solve here at LPL as well.
Yeah, 2 things to respond to with what you said, Jared, and I think spot on. I think the first is just to draw an important distinction between Focus and Hightower and LPL. With Focus, traditionally, they're investing directly into someone's own RIA, where Hightower, you're talking about a central operating platform, is folks joining Hightower's RIA and Hightower's broker-dealer, which is somewhat similar to LPL. But I think kind of important distinctions as far as the responsibilities and level of autonomy that an advisor has post-transaction. The other thing I'll respond to is what you're saying about the next generation of advisors. I see it the exact same way that you do, that many of these M&A deals are life-changing opportunities for the founder who may be retiring in a few years. They got a huge check given where valuations are. They were able to set up their clients with a compelling firm, but there's a big gap for the next generation advisors. I wrote an article recently about what I deem as the next big breakaway movement, which is breakaway advisors from RIAs. And I think ground zero are these large private equity backed roll ups, aggregators, serial acquirers, whatever you want to call them, who have acquired these amazing firms with great advisors, but the advisors no longer have ownership or much less ownership. They don't have a path to taking over the company, and they're stuck in many regards. So I'm excited to develop more of how LPL is solving this concept. And let's kick it over to Jeremy. So, like you said, you've been an LPL for a large portion of your career, absent the short hiatus in the RIA world. So you've really seen the firm rapidly grow its headcount, its AUM, its standing in the marketplace, et cetera. Can you talk a little bit about how you've seen LPL change over the years? And hopefully you can be candid about where it was versus where it is today, because it's a very different company.
Absolutely. A lot of change, a lot of growth in over 2 decades that I've been a part of this, which was remarkable. And I think we set out very early on we had to establish some size, and we saw the benefits of size and scale early on. And we tried to continue to use that as our strength of ours. And I'll talk about how we did that. But when I began, it was a founder-led, founder-owned firm. We did things a certain way, and we were early on in determining that fee-based business, advisory business, is a really important aspect. And so we wanted to make sure we attracted advisors and could support advisors that wanted to move in that direction, which we thought was pretty early back in the early 2000s, which was a great place to be. We also saw the benefits of being a self-clearing broker-dealer and custodian, which I think created an advantage for us in the marketplace, and that we could generate different economics than others could do. And I'll get to why that's important, because we were able to reinvest those economics in our sole business, which is supporting advisors. And so taking you through the journey from founder-led, founder-owned, we then became private equity owned in the mid-2000s, eventually to a public company in 2010, and then the last 14, 15 years as a public company. Interesting changes along the way. We learned a lot. We made mistakes along the way. We applied those learnings and continued to get better. We had highs and lows throughout that period of time, but the firm kept growing. Headcount, like you said, kept growing AUM. We kept investing in the underlying business, investing in both horizontally to support advisors wherever they are. I think across the spectrum of being able to support employee advisors all the way through our independent RIAs and everything in between. We also invested vertically and really scaled vertically, and that's adding more capabilities to help advisors run thriving businesses, run more efficient businesses. And so one of those examples is what Jared and I do. We were able to think about deploying capital differently. And so thinking about different capabilities we could support advisors in their growth, in their protection of their businesses and their legacies, and being able to help them unlock value of their life's greatest work in many cases. And so that's what we saw the firm transform. And now we're able to continue to reinvest at levels that a lot of our competitors probably can't match. And I think it's going to help us continue on the journey we've been on, which is just be able to support advisors more fully wherever they are.
Yeah, I agree with you. And I'll give a round of kudos or props, whatever you want to call it, to how I view LPL's transformation in the industry. To me, LPL tends to be typically on the leading edge of developing new business models, new affiliation options, and really figuring out what it is that prospects or prospective advisors want, but also how to better support their current slate of advisors. So it's I think a very good segue into much of what we're talking about, which is the liquidity and succession program. And I think you have some other names for other programs and how LPL is doing that. So Jeremy or Jared, whichever one of you wants to answer, can you describe the need that LPL saw in the marketplace to launch the liquidity and succession plan? And maybe to take a step back, if one of you can even just briefly describe the value proposition of the liquidity and succession program.
Sure. So I'll kick us off. This is Jared, and I'm sure Jeremy will have some thoughts too. Liquidity and succession, in short, is LPL competing with many of the private equity-backed aggregators, roll-ups. Lewis, I'll use your words, whatever you want to call them, competing with those firms, but in a way that doesn't compromise an advisor's identity, an advisor's brand, the way that they service clients, and keeps that continuity in an independent practice for many years to come. And I think that the really big piece that separates us from many of our competitors, not only the fact that we're not changing the name on the door and painting the walls a different color, is the fact that we've actually attached to the M&A event. And this is LPL using its capital to acquire an advisor's book of business. And they're staying with LPL, or they're coming to LPL to do that. We can talk more about that later. But the really key differentiator for us is that we don't have an upcoming liquidity event in 5 to 7 years. We're not pressured by a private equity firm that backs us, that is looking to get some return on its investment. And so we're really doing this with, and we're not kidding when we say it, we're doing this with the next 20 plus years in mind. And we did this, and this kind of segues into what need do we see in the marketplace. We did this to protect the independent wealth management space from what we saw as a return to conformity. And we saw this trend over the past 20 years. It's really benefited LPL, of advisors leaving models where they were forced to sell proprietary product, that they weren't able to have their own brands or talk to their clients the way that they wanted to. And now we're in this place where advisors are going back to a firm that controls the way they communicate with clients, controls the way they brand themselves, controls the way that they do business. And so we saw a need to not only solve for Gen 1 and acquire the book of business at really competitive market multiples, but also set it up such that we were giving economics and equity back to the next generation so they could continue on that legacy of independence. And that is liquidity and succession in a nutshell, is solving for that M&A event and then giving it back to the next generation. And the reason why we got to work and launch this and have had so much success over the past couple of years is that we didn't see anyone else that was stepping in to do it. Everyone else started to look and feel very similar to each other. And that's not a slight at all, because I think they're mostly pursuing a very similar strategy, which is go out and acquire as much AUM as possible, as many businesses as possible, centralize the brand, centralize the service organization, centralize the operations, extract as much profit as possible for the private equity backer that has invested in the business, and grow at all costs. And for us, we saw that as not only a threat to LPL's business model, because that's contra to our belief that we should support independent advisors however they see fit so they can service their clients. But we saw that as a threat to the industry. And that's why we've invested so many resources in growing this program and allocating so much capital to it. We've talked about it on earnings calls. And we're very open about the fact that we see this as not only something that's protecting the industry, but as a really big growth lever for LPL. So, Jeremy, I'm not sure if you want to add anything there.
I would just, it's more of an emphasis. I think that Jared's spot on in everything he said. I think we definitely saw a need to be different than what all the models are out there, in that one key distinction that he mentioned, which is perpetuating that independent business model. We're not looking to aggregate all this together and create a bunch of synergy to then resell and see what happens with the client experience or the G2 next gen experience with advisors. We actually have a longer term view, and we actually want to get these businesses back to the next entrepreneur and continue to perpetuate that model, which I think is a really key differentiator out of the marketplace and a need that we saw. And it clearly is resonating with our existing advisors that have gone through this program, as well as those outside of LPL that are thinking about moving to LPL to take advantage of this.
Yeah, I would emphasize as well, the really different part of what you're doing is the fact that after a certain term or period of time, the next generation, whether it's a family member, it's a team member, or it's another advisor that comes into the business, is able to fully own the business and can do with it what they see fit. That is something that we certainly don't see. I'm curious though, maybe Jared, because you were front row to this, how is this different from, let's say, Focus, where Focus is acquiring a portion of a business and then there's equity that's granted or distributed or recycled to the next generation? How is this a shift from that model?
I think the key difference, number one, is that equity that's granted comes with it a lack of true control. And so I question in the Focus scenario whether or not you're ever, and I'm thinking going back last summer, where Focus had management company equity in most of the businesses that they acquired. I don't know that as a next generation person, you really had an open market to actually monetize that equity. And so there's a lack of control of your own destiny in that scenario. And maybe that'll change as Focus evolves and we're all watching what happens in the press. But the key difference here is that we are really seeking to keep independent wealth management independent. And we are keeping this localized, and we're doing it on a practice by practice basis where if there's no next generation advisor existing in the business today, we are helping find those folks, whether it's inside of LPL or outside of LPL. If there are existing next generation advisors that are in the business, we are working with them and building a transition plan such that they take over that business. And it's not having a small piece of equity in a much larger pie, which can sound really interesting. It is having equity in a business that you've been working in for sometimes 10, 15, 20 years, whatever it may be, by the time that the transition is over. and really controlling the destiny on what that looks like. And our big bet here, Lewis, is that as LPL continues to evolve and grow and make itself a more attractive platform, that those advisors are going to remonetize with LPL down the line. That this becomes a perpetuating program. When an advisor is ready to monetize, they go through the liquidity and succession program, and the next generation comes into their seat and continues that brand, that independence, and maybe a little bit different, but continues servicing clients without the obstructions of a mothership entity, if you will.
Well said. Yeah, I think that the point that the equity that a lot of advisors get from some of these acquirers, there's not an open or free market for it. And you can only trade it back to the firm or perhaps monetize it if there's some sort of liquidity event. And you don't have any control over how that is, when it is, or who it's to. So I think that's a great point. So in this model, who is the ideal target? Is there a certain AUM requirement? Like, are the advisors mostly coming from the outside? Maybe just paint a picture for who this works for.
Sure. And it started a little fairly narrow, but we've expanded where the ideal target could look like, which is good. But I think it's largely reserved for the largest practices initially within LPL. And so think about over 100 million, over 150 million of AUM. This tends to make the most sense for the larger businesses. And we thought that having G2 in place, identified successor or successors, was a really good place to start. This created a really interesting bridge for them. Well, sometimes it was sons or daughters or just people that had been there a long time. And this was a way for them to transition the business to the next generation without that second generation taking on a bunch of debt or for having the principal seller having to contort themselves to take a discount on the valuation. It was a really interesting solution for that persona, if you will. But we've found in getting into this, there were other interesting targets or ideal targets. And so we've also got a version of this that works for folks that don't have a definitive timeline for retirement. And so you mentioned the many names we call this. We call that liquidity and growth, Lewis, and where the advisor can take advantage of all of the benefits of a liquidity and succession structure, but maybe doesn't have a retirement plan yet, timeline for themselves yet. And we can work with them, as Jared said, over time to identify successors, develop those successors, train them, mentor them to get them ready for whenever that time comes.
Interesting. And now that the model is off the ground and you have some proof of concept, are you seeing that there's more interest from folks outside of LPL, or is most of the focus still internal?
Yes, we're finding that, I think it was last September, October timeframe, it took this externally, took this outside our walls, and we're finding that this is definitely resonating. And it's resonating across really three major channels. We're seeing existing RIAs that are interested in this. We're seeing plenty of IBD advisors that are interested in this. And there's also a really great application within the wirehouses. And we've got a unique solution there, I think, as well, that are really good competitors to the existing sunset programs that exist. So in short, I think we're finding that the story does resonate and is fairly unique out in the marketplace.
Yeah, I would agree. Can you give an example of how a deal structured? I mean, if you can use like a hypothetical example, you can share a multiple if you want to, but maybe just the overall methodology or thinking and being as specific as you're allowed to be would be great.
I'll keep it more high level because as we've grown, Lewis, I think our deals have become more creative. And I don't want anyone to listen to this podcast and come back and say, that's not what you talked about there. It's a little bit different. But I think that the key tenets of a deal for us are, number one, 100% cash consideration that we're paying. And that is very different from most of the marketplace because LPL is a publicly traded company. We feel like if you want equity in LPL, you can buy it on the exchange. You can take the cash that we pay you and go out and purchase it. Or as an employee of LPL, you can participate in LPL's employee stock purchase plan, however you want to structure that. But all of our deals are structured as 100% cash. That's number one. Number two is generally we keep it fairly simple. And we're paying, in most cases, 3/4 of the deal proceeds up front. We don't have growth earnouts that are 50% of the deal in year 5 or year 7. And LPL doesn't have to grow by a certain amount for you to get paid. It's fairly straightforward in that 75 to 80% of the consideration is paid upfront at close. And then generally in most deals, we have a growth earnout that's paid in year 3. And again, different from most of the marketplace, generally that earnout is paid based on the growth of assets under management on LPL's platform. And that is because in a really positive way, we make money as a firm very differently from most of our competitors in this acquisition marketplace. And so we feel like as your assets grow, LPL grows, we're all winning. And so we'll actually pay the earnout based on the growth of AUM on our platform.
Interesting. And how do you make the economics work? So if LPL is paying a competitive multiple at the end of a certain period of time, the next generation owns the business. How do you make money on this? In other words, what's the give up? Why wouldn't every single person do this if there's no trade-off? Like what happens to the payouts? Like how is LPL recouping their investment?
Sure. It's a good question, Lewis. And I think everyone should do this just to
I figured.
it's really a buy down of compensation, right? So that's where LPL makes its return on its capital here. So we're buying the business, we're tucking it into our employee model. This is where we're able to put the big LPL bear hug around the business, take a lot of things off of the advisors and their team's plates where we can, have them focus on clients. And we get our return from keeping those assets on the platform and growing them. Because as Jared said, we monetize assets as a broker dealer and custodian differently than a lot of the aggregators we've talked about. But we also have essentially a reduction in compensation for those advisors. We're buying down the compensation, and the advisor team has an ongoing pool of variable comp, but at a lower level, IBD and RIA payouts.
That makes sense. So is the payout that the advisor servicing the business or the founder gets after the deal, is it similar to a payout perhaps that someone who sold their RIA would get? Maybe it's a 25, 30, 35% payout instead of a 90% payout or 70% net of expenses.
That's exactly right. So in the traditional deal structure, an advisor that sells, and also any other advisors that are servicing the practice alongside that advisor. And that's an important distinction because we do think about that holistically. It's not just that the seller is paid that 30% of top line revenue. It's that any advisors servicing the clients can be included in that variable payout bucket. But typically it's 30% of revenue, which we feel like is generally the minimum, if you will, to incentivize folks to come to work each and every day. The other interesting point there is that 30% is generally only fixed in the earnout period for us. And this is where we start to incentivize the next generation because we'll actually start to increase that payout after we've paid the earnout to incentivize the next generation advisors to continue growing. And we'll increase it all the way up to 70%, which is the top of our W-2 payout grid, to incentivize them to continue growing. And again, I think very different from most of the competition that we've seen, which is buying a stream of cash flows and fixing that stream of cash flows. And they're going to pay the advisors a fixed amount based on the deal that they structure. We don't really view it that way. We view, again, growth as something where all of us win. And we don't want to hinder the growth of the business and own the economics on that forever. And so we'll actually increase that payout over time for advisors that are in the practice.
Very interesting. So as we're talking more about this, the best comparison I could think of in the marketplace is a wirehouse sunset deal, whether it's the UBS Alpha program, Merrill CTP, Morgan Stanley's FAP, Wells Fargo Summit, and most firms have some sort of derivative of the same concepts, which is advisor retires, they're getting a lump sum payout, typically over a couple of years. Next generation takes a reduced payout, and then they're getting full revenue credit for the business at day's end. I know there's some major differences with this program, presumably on tax treatment and the like, but maybe you can just take a second to compare this deal that you all are featuring to a typical wirehouse sunset program.
Sure. I'll take this one. I'll start off. So one, you did hit on the tax treatment and disclaimer that we encourage anyone who sells their business to LPL to retain their own tax representation to help them sort out the recognition of the gains that they're being paid. But that is a really important distinction. I think that like a little bit higher level than that, what we're buying from any advisor that does a deal with LPL, similar to everyone else who's in this industry outside of the wirehouse, is the client relationships. We are buying the clients, the goodwill from the advisors that have been servicing the clients. And I think that is quite different from a traditional wirehouse sunset program because in most cases on that side, it's just an ordinary income payment, right? You're buying down the compensation that's being paid to you. You don't actually own the clients in the wirehouse construct. So you can't really make the case that this should be a long-term capital gains event, that you're selling any kind of goodwill. And so that's a key differentiator for us. But I think more importantly than that is just the ownership of your destiny over the period of time in which the next generation is participating in this deal, or even the selling advisors participating in this deal. Most of those sunset programs dictate a pretty specific timeline for an advisor to kind of transition out or take less of the business after they've quote unquote sold to the mothership. For us, we recognize that retirement in this industry is not so black and white. And I think most advisors would agree with that they don't know what they would do with themselves if they weren't servicing clients. So maybe they want to stick around 1 or 2 days a week or just be in more of a business development capacity. And we have the flexibility on our side to recognize that those outcomes can be really positive for a business where maybe next generation is steering the ship, but the selling advisor is still around building business, whether it be on the pickleball court, which I think is more popular than golf, or the golf course. But in any case, I think the flexibility that we have to structure something that really meets both the selling advisor's needs and the next generation advisor's needs is a key differentiator there. And then I think the third piece is just this successor advisor program component of what we've come up with is very different from what a successor or a next generation advisor signs up to in the wirehouse, in that, again, we want you to control your destiny. And as Jeremy mentioned, this is built on LPL's W2 model, which is a really fast-growing component of LPL's platform. But we've got other affiliation models inside of LPL. And so if someone decides that at the end of this transition period, they really want to run their own RIA, well, they can custody with LPL and there's really no transition and there's no disruption and they don't have to break away from anywhere. Or maybe they decide they just want to be paid in a 1099 capacity, which is obviously our bread and butter. They can go and do that as well, or they can stay in the W2 construct. And Jeremy describes it as a really nice LPL bear hug. I describe it as one of the few Fortune 500 companies that has an operating platform supporting advisors who can just show up to work and service their clients. And so we're betting that a lot of folks will want to stay in that construct as well. But again, the flexibility to do what you want after that transition period over is pretty different from most of those programs.
Yeah, I think that's very well encapsulated. And it's thinking that with the wirehouse sunset deals, the retiring advisor monetizes, they're on their glide path out, they retire. The next gen advisor is putting in all the sweat equity to keep the client relationships, manage the business. They get a lower payout over the duration of the deal, which is reasonable to, in essence, pay off what the retiring advisor got. But at the end of the day, the employer is still owning the business. So it's sweat equity to, in essence, transfer ownership or retain ownership with the same entity, which is the wirehouse or the bank. So to me, the most interesting element of what you're doing is the fact that the next generation advisor actually owns the entity, owns the equity at day's end, and then can do with it what they want, sell it again, move it, and have agency over what that looks like. So it is seemingly a better deal for certainly the next generation advisor, especially. So well said. How do you guys view this deal comparing to other typical M&A transactions that we see in the RIA world? I think we've hit on some of it, the cash versus equity, but are there any other key distinctions that we haven't mentioned that are worth calling out?
I think you're right, Louis. We hit on a lot of them, and I'll just try to summarize. So there's a lot of things that are similar, and it was designed intentionally that way. We wanted to mirror the stuff that was working well in the marketplace, but then add some LPL flavor. And so deal structures are similar, as we've described, the exception there being we're 100% cash up front. We're trying to take things off advisors' plates to make them more efficient, to have them focus on their clients, the reason they got in the business in the first place. And so that's similar to what you'll find in the marketplace. But we are also protecting that local flavor, that entrepreneurial spirit. So while we're taking stuff off the plate, we're not changing the brand. We're not changing the way they work with clients. We're not changing their staff, and making sure that we ring fence that and protect it. So that is somewhat unique in the marketplace. And then providing that path to growth. And I think the path to G2 is the real big differentiator we've talked about. Just to summarize that is a big thing that's different than what you'll find out in the marketplace. One thing Jared and I talk about all the time is it's going to be interesting to see. You talked about the next breakaway wave. I think you're spot on. But like, what's going to happen when these private equity-backed firms go to sell? What are they going to do to put lipstick on the pig, so to speak? What are they going to do to pretty it up, to make it ready for sale? What's that going to mean for the talent that's there? What's that going to mean for the client experience? And are we going to have a wave of next-gen talent that leaves those firms when they go through that transaction? And so we built it differently so we don't have that issue.
Interesting.
I was just going to add there, Louis, another key, and just to hammer home points we've talked about, we're not doing this with the expectation that we bundle up all of these advisors and sell them somewhere else in a few years. And we're not restrained by those timelines. And I think we're starting to see that narrative play out in the marketplace, where what is the next trade for many of the aggregators who've bought up these advisors? And what happens next if they can't trade? Are they going concerns for the next 20, 25 years? Or what really is the next phase of the evolution for the PE-backed roll-up? And for us, I call that out as a key differentiator because we're doing planning here, strategic planning that goes out 10, 15, 20 years. We built a program that rewards advisors over the course of 10 to 15 years. And we're thinking that far down the line about the perpetual nature of this. And I think it influences everything that we do because we do believe in the power of independent advice. We do believe that disrupting an advisor is not the right thing to do, that the advisor mediated marketplace is here to stay. And that's, again, comes back to why we built this and how we're investing the resources to continue growing this and growing our reach to both serve LPL advisors and welcome advisors from outside of LPL to participate in a deal like this.
Very interesting. So, Jeremy, I got a question for you. You've been in the IBD world with LPL for most of your career. From my experience, if a independent practice under a broker-dealer is going to sell, we typically see a bit lower valuations than an RIA looking to sell. Some of it's business mix driven. Is it all fee-based versus 30% fee-based with 70% variable annuities? So there's some of that. But more importantly, historically, we've seen a lack of capital behind acquirers who sit within a BD. You don't typically see private equity firms backing IBD practices. And most often, a buyer is going to either be the internal team, which can still be the case, or it's going to be a local practice who maybe has done one deal, maybe has done two deals, but may or may not have the robust capital backing that a private equity backed RIA or LPL itself would have. So I have a follow-up to that. But first off, do you agree with this concept? And if not, how do you poke holes in it?
Sure. And I get that's a position and a perspective in the marketplace for sure. And again, as you said, my experience has largely been in LPL, and LPL is a very large ecosystem. It may look a little different than some of the other smaller IBD ecosystems out there. But in my experience, we haven't found much of a difference in valuation, which was interesting. And we actually, now fully disclose, LPL sponsored the study, but Advisor Growth Strategies did a study around that and thinking about dispelling valuation myths and what really drove value within advisors that had a shared ADV versus those that had their own. And there wasn't much of a difference. And in the M&A data that we've seen inside of LPL's walls, there isn't much of a difference in terms of EBITDA multiples or revenue multiples or anything like that. What we've found is, and your business mix point is a really good one. Yeah, to the extent the business mix is different, sure, there's going to be a difference in valuation. But if you take a like-to-like practice, the one that looks very similar in terms of business mix between fee-based and broker-dealer business, and they're of similar size and similar growth rates, there shouldn't be much of a difference in valuation. What we found is the real big drivers of value are the standards: profitability, growth. Am I in a good market that has prospects for continued growth and expansion? And finally, and a very important one, is the team and talent that you've got there. And so those are the big four, really, what determines valuation or a premium valuation. How advisors conduct business under what type of construct is less important, we found. And because there's puts and takes, right? So having your own RIA, you've got to do compliance. You're on the hook for that. And you've got the SEC knocking on your door and making sure you're doing everything above board. Advisors under a shared ADV like at LPL don't have to worry about that. LPL takes care of it for them. It's a version of outsourcing, and it creates scale in their business. And so there's puts and takes there, but my experience, I haven't seen much of a difference. But one point I would say the exception to that is the point you made. The more buyers that are well capitalized and on the open market may drive up valuation, and we've seen that in the marketplace. But the big question is, how high will that go? Will that remain, or will that come back? And so that's the one exception to everything I've said.
Yep. That's exactly the way that I've seen it too with some of the transactions that we facilitated, is that a like-for-like business, the value isn't necessarily any different. Ultimately, someone's going to pay what they think it's worth, and that's going to drive the price. But I do think there's credence to what you hit on, Jeremy, about how if there's more bidders, it has the potential to drive up the price. So in the RIA world, if you have 25 private equity backed acquirers who are gunning for a deal, naturally you'd expect someone to go to kind of the next multiple range, and competition does drive price. So fundamentally, I agree with you. And that's what I've seen too. The valuation shouldn't be different, but typically with more external bidders, there's potential to increase the valuation. Let me go to my next question, which is related. Let's say an LPL practice or any practice were looking to sell to the liquidity and succession program. Wouldn't they conceivably get a higher valuation if they shop the deal to dozens of external well-capitalized acquirers, or even shopped it within LPL's ecosystem of well-capitalized buyers?
It's a great question. I was going to interrupt you guys before, but the person that's helping us with this told me not to talk over Jeremy because we're on one mic. So I didn't do it. But what I wanted to, the point that I wanted to get to, and I'll just share an anecdote, Lewis. We were going through a process recently with a center of influence who had brought us a deal from outside of LPL, and it was an independent, and we didn't end up winning this process. I want to be forthcoming with that. But what came back was you guys are by far paying the highest cash multiple of all the offers that we saw, but you're the lowest. You're the lowest offer of all the offers that we saw. And I think that's a key point about open marketplace and multiples and valuation is that we come back to, we pay 100% cash consideration in these deals. We think cash is king. Again, we're a publicly traded company. We'd be very happy for advisors to buy our stock. But in a lot of cases, I think when you start to see these really inflated multiples, a lot of it is in private, illiquid equity without a confirmed date on whether or not advisors going to be able to get liquidity out of that deal. And further to that, I think we're starting to see a little bit of a reckoning with what kinds of multiples these aggregators are going to achieve in the marketplace. And I think a lot of the assumptions that are built into a deal where an advisor gets this crazy multiple, and we've all been to the conferences and we've heard my buddy down the street got X and my buddy up the street got Y. Well, a lot of those assumptions are based on a firm trading at a really specific multiple. And I think where we sit, our opinion is that cash is king because it's certain. And the market clearing transactions that have happened to affirm those pretty crazy multiples have either been to a large strategic that might not be in the interest of the advisors that are being sold to that place, or into the public markets, but we're not seeing as much of that anymore. And so I don't know if that takes your question sideways, but I think what we question is the validity of the assumptions under some of those valuations that advisors are seeing in the marketplace. And we just encourage you do your reverse due diligence. Dig into the numbers, dig into the valuations that you're seeing, the projections that you're seeing. Are you banking on something that's realistic? Or would you be better taking your cash and putting it into a fund of funds that's betting on the best managers? I don't know. I'm not counseling anyone either which way. We just have a healthy skepticism of how the industry is talking about it.
Yeah, so it sounds like what you're saying is it's the structure matters more than the valuation. And you feel like the structure you have in place is perhaps more advantageous than other bidders, even if the overall valuation might be lower because you're not shopping the deal to 20, 30 different potential buyers.
Lewis, I was going to say something very similar to that. I think you're right. I mean, those 20 to 25 bidders, all the offers look very similar. I think ours is very different in the reasons we've talked about. And so you're essentially comparing apples and oranges in some cases as far as what the experience is going to be on the other side, not only for the selling advisors, but also for the next gen. And so that's the thing that they need to evaluate is, do I want one of these 20 offers that all look very similar when I'm going into a model that all feels very similar, or do I want something a little bit different? And so it's all about fit at the end of the day. It's not always about the highest price.
Well said. So either or both of you, what attributes do the best businesses have as they go through your evaluations? Or put another way, if someone's listening to this, they're thinking about how to maximize the long-term value of their business, what are the key things they should pay attention to or try to influence before they go through a transaction process?
Yeah, we spend a lot of time with our advisors and talking about this, and we have some interesting offerings within LPL where we actually can hold up a mirror to the advisor and say, here, let's look at your practice right now. You've got a 3-year timeline. Here's some things we can do in the interim to really get your business ready to sell. And so things like looking at some of the things we talked about. Do you have sustainable organic growth within the business? Do you have the right talent on board? And have you developed that talent? Have you identified potential successors in the business? One thing we've done is we've actually looked at the underlying households. Are there some households that no longer fit your service model or aren't a good fit for your business? And can LPL purchase them, support them with essentially our investor-focused solutions team, a team of advisors that can work with those smaller, somewhat mismatched households that advisors no longer want to support. We can do that for them, provide capital for in exchange for that. And it creates capacity in the business as well as capital potentially deploy for growth, which is a really interesting virtuous cycle, if you will. We have advisors that use that partial book solution on a regular basis. And once a quarter, once a year, they come back. And as they continue to grow the top end of their business, they're able to maybe find a better fit for their lower end of their book of business. Just as an example of things that folks do to get their businesses ready for the ultimate monetization event.
Well said. Jared or Jeremy, what's your view on where valuations are heading? Do you think we've reached a peak, or is there room to run? I've held the view for a while that I think it's subsided, but it felt like the last few years we were approaching bubble territory where the price of these assets just kept going up and up. And ultimately, it's hard to see how the plane was going to land. If ultimately there's a maximum amount that the next private equity sponsor is going to pay to buy one of these large firms, how do they keep increasing the valuation without some crazy external factor happening that we're unaware of? So what's your viewpoint on this? Do you think valuations will go up, or do you think we've reached a point of equilibrium, or maybe valuations might go down?
I think we've reached the point of equilibrium. And as I mentioned before, I think what we're starting to see is a fundamental question around what the exit is for some of these private equity backed firms and what the future holds. And I think that'll naturally lead to a normalization of where multiples are. And I don't think it's going to go down by half, but I think some of the crazy numbers that we've seen thrown around are happening less and less. And I guess what I see from my perspective is that most of the folks who are saying, hey, multiples are only going up and are at a record high are the people that are being paid directly and benefiting from multiples being high and continuing to go up. And so I question how much further we can run. I don't think it's necessarily a bubble that's going to pop and go down by a significant amount, but I certainly don't think we're where we were in 2020 or 2021.
And I'd add, Lewis, my perspective there is what I've experienced and what I am is I've seen a bit of a pullback in two ways. We had the cost of capital shoot up with interest rates, and that's certainly everyone thought that was going to affect valuations. And I believe it eventually did, but it did in two different ways. One, I think the multiple overall has come back a little bit, rolled back just a little bit to something that's not as close to bubble territory, like you mentioned, as it was. And you've seen a shift, and Jared's talked about this, a shift in how much of the consideration was cash versus this private equity. And so we've seen more of the upfront consideration shift towards the equity versus in the cash because of the cost of capital and taking on leverage in the businesses. So those were two big things that we've seen. And then you've got, I feel like there's this game of musical chairs, and a lot of chairs have been removed. The music hasn't stopped yet, but there's going to be a lot of folks looking for missing chairs when it does. And we've seen some headlines around some large firms, private equity back, go out to the marketplace to try to recapitalize and not get the valuations they were hoping for and having to stop that process. So to me, there's a couple data points there to point at that suggest that's where we're headed.
Interesting. A question I want to ask you, it just came to mind as we're talking about equity. So the pitch that any firm that has equity as part of their deal structure points out is that if you take some of your deal consideration in equity, you're diversifying your growth essentially. Instead of being 100% reliant upon what clients you keep, how you grow your business individually. Instead, you have that lever, but you also have the lever of our equities compounding at 15% per year. And you get the benefit from all these programs we're doing and all the M&A we're doing. How would you respond to that? I mean, I know equity, we always say, is it's in some ways like a lottery ticket. I mean, I think in this industry, equity tends to be a decent bet, but we've seen instances, not naming names, where that certainly wasn't the case. Or I think I know which firms you're talking about, Jeremy, who went out to market, were promising a certain valuation to their advisors, and they weren't able to pull it off. But with that kind of example aside, how would you react to that concept that equity as part of a deal structure, which is different from how LPL does deals, is actually a pretty compelling diversification lever for an advisor?
And I know Jeremy has thoughts here too, but my initial thought is that if it's equity that is the cream on top of the valuation that you're getting, and you feel like you're getting a fair deal on a cash basis, and you can take that and put it in the bank and diversify it how you want, and then there's an additional equity component, then great. It's a flyer. It's a bet on whether or not this firm will compound by 15% per year. But as an advisor, if you are trading your largest personal asset in most cases and simply swapping the equity and not getting much cash, and you're getting a below market multiple, which we can all reference and figure out what that would mean, then I think it's not such a great bet. Because I think, as Jeremy alluded, we're not seeing the same exit events that we were 5 or 10 years ago for most of these firms. And I think it is a little bit of a musical chairs type situation with who's on the other side of the next trade.
And I would just add, and admittedly, I'm an LPL homer, but I would rather take the cash and invest it in LPLA I think that's a better bet.
Yeah.
All right, there you go. I like it. So, Jared, I know you and I over the years have talked about this concept over a couple of beers, but what do you think the industry will look like 5 years from now in general? And then also just overall, is all the consolidation that's happening, do you think it's good for advisors?
Well, I don't have a beer in my hand, unfortunately, to maybe pontificate as I would if I did. But I think two things. So one, I do think we are going to see, instead of the continued aggregation of advisors into these PE backed platforms, I think we're more than likely going to see more advisors start to leave. And you referenced your next breakaway wave article. I think that's very real because I think we have a lot of talented next generation advisors who are wondering what's next. And that leads me to point two, which is I think this industry has to grow up a little bit. And I think we have to start thinking about talent strategy from cradle to the grave. And what I mean by that is the independent space is going to have to invest in advisor training programs to seed the purchases that they're doing. Both we're thinking about that as I think large PE backed firms should be thinking about that. And so I think that's the next theme is how we're starting to mirror maybe something like the accounting world, where you take 1,000 graduates from universities and train them up, and then they go out in many different ways to regional firms and boutique firms and independent firms. And so I think that's a coming theme that we're going to see because there's a real talent shortage in this industry. And I think what we're all going to find is we've bought some really successful advisors, but the next generation is not quite there to continue servicing those clients.
Well said. No, I agree. I think it's a really interesting analogy. And I've heard the accounting firm analogy describe kind of the way industry consolidation is happening as well, where in the 50s, 60s, 70s, you had all these disparate local, regional accounting firms. And then you saw the emergence of the big eight and then the big four. And now you have a similar dynamic where you have the big four, you have lifestyle businesses, you have some of these regional players. And I've heard that analogy too for the way in the RIA industry is going to look at day's end. But I love what you're saying about how someone or someone's have to figure out the training of the next generation, because simply the next generation that is left in many of these firms, they typically don't have the same business development acumen. They may not have the same relationship skills that the founder did. And as those advisors leave, they go to other industries, et cetera, there's likely a pretty big talent shortage, unless maybe AI and other technologies will make it so that a typical advisor can service 300 households instead of 100 or whatever the typical is. But I'm with you on that description. One last question for either or both of you. Any parting words or advice for those thinking about their business like a business, looking to maximize the value and potentially sell it in the future?
Yeah, I'd say the advice I like to give is to be intentional about it, determine what you want to have it look like, and look critically at your business. Have someone hold up a mirror if necessary to really understand the areas of strength and areas of weakness and the things that you actually that are actionable and you can improve and enhance and drive towards that premium valuation that you're seeking. And also, it's not always about valuation, as we've talked. You want that and fit, and you want to find the best fit for you, your clients, and your staff, the holy trinity of the advisor practice, if you will, and making sure you've got a fit for all of that.
I think what I would add there is in terms of being intentional, we have plenty of conversations with advisors who, and in the past have dismissed the idea of selling, dismissed the idea of succession planning. I've got 20 years. Um, if this isn't part of your normal course business planning, if you're not educating yourself on what the marketplace looks like, you're not only doing a disservice to yourself, again, with your most likely your largest personal asset, but you're doing a disservice to your clients that have entrusted you with their assets, to your employees, to your family, to all of your stakeholders. And so that's my parting words are don't ignore the chorus of voices that are talking about M&A and succession planning, because it's a really key part of this industry. And educating yourself now well ahead of when you execute your event is only going to lead to a more positive outcome because you're going to be an educated buyer, as you would with most other things in your life. And so it's just, yeah, be intentional and do it 10 or 15 years in advance. I'm sure things will change, but stay on top of the trends and understand what different options mean for your business and what the impacts would be for your clients, et cetera. And you'll be well positioned to take advantage of that eventual exit or succession or transition, whatever you want to call it.
I'm with you guys. What I've found is the actions that someone can take with intentionality or to be proactive about that can drive a higher valuation, even if you decide not to sell, are just really good business practices that are going to help your business. So I think with everything, a little bit of planning, education, taking time to work on the business instead of always being in it is always a prescribed formula. So guys, this was really interesting and eye-opening to me as well. What you've created with Liquidity and Succession, I think it is a differentiated offering in the market, a pretty interesting alternative to a traditional wirehouse sunset deal, to trading to a private equity backed RIA or a roll up or an aggregator. And I think we hit on a lot of key themes that any advisor can learn from as they look at maximizing the value of this immense asset that they've built over the years. So we'll have to do this again, but thank you both for joining us.
Thanks for having us.
Yes, thanks, Lewis.
Curious about where, why, and how advisors like you are moving? Download the latest Advisor Transition Report to learn more, including intel on recruiting deals and our insight and analysis on the latest trends in the wealth management space. You'll find it at diamond-consultants.com/transition report. Or if you'd like to talk, feel free to give us a call at 908-879-1002.